Hey there, and welcome to This Explainer. If you're a Canadian business owner, you already know the drill. Growing your operation usually means acquiring some seriously expensive, heavy-duty equipment. But doing that without completely draining your cash reserves, well, that's exactly where things get kind of complicated. So today, we're bringing absolute clarity to the equipment financing landscape. We're going to look strictly at the hard data from industry leaders to decode exactly how traditional banks, private lenders, and crown corporations look at your business. The goal here? To help you stop guessing and start building. Here is our roadmap for today's explainer. We'll be hitting 1. The core difference. 2. Visualizing the market. 3. A side-by-side comparison. 4. Real-world scenarios. And finally, 5. Choosing your best option. Okay, let's jump right into section 1. The core difference, under the hood of equipment financing. Okay, let's really dive into this because this right here, this is the ultimate aha moment when it comes to equipment financing. It literally all boils down to one fundamental difference in how they underwrite. Traditional banks, well, they lend mainly against you. They are betting on the borrower. That's exactly why they want to see 2 solid years of audited tax returns, pristine credit scores, positive net income, the whole shebang. To them, the machine is just a backup. Private lenders, on the flip side, bet on the machine. They look at the brand, the remaining life, and the resale value of that equipment. In their eyes, you are the backup. This single, crucial distinction explains why a private lender might happily approve you based on just 6 months of bank statements, while a traditional bank is going to put you through a rigorous multi-week audit. But here's the wild part. Despite these totally different approaches to risk, underneath it all, both types of lenders actually secure the loan in the exact same way. They use the Personal Property Security Act, or PPSA. So whether you go with a bank or a private lender, you own the equipment and you run it. The lender simply holds a registered lien on the machine that only ever activates if you default. The day you pay off that loan, the lien clears. So the collateral mechanism is identical across the board. What actually changes is who they say yes to, how fast they do it, and of course, what it costs. Moving right along to section 2, visualizing the market, scale and scope of lenders. Now, what's really interesting about this slide is this absolutely staggering figure, $400 billion. That is the value of assets financed by Canada's private asset-based equipment and vehicle finance industry in 2018 alone. Sometimes people hear the phrase private lender and they instantly picture, a shady back alley deal. But the reality is the exact opposite. This is effectively the second largest source of business debt financing in Canada, sitting right behind the major banks and credit unions. It's a massive, highly regulated, and totally mainstream channel. And then, oh man, we have the option that so many contractors just completely forget about, the Business Development Bank of Canada, or BDC. As a federal crown corporation, BDC sits right in the middle of this market. And what makes them incredibly unique is that they can finance up to 125% of the equipment's purchase price. Why does that matter? Because it allows you to roll your freight, installation, and even training costs directly into the loan. That is absolutely crucial for preserving your day-to-day working capital. All right, section 3, side-by-side comparison, data breakdown. Let's look at the actual trade-offs here. The charter banks, they're going to give you the lowest rates for sure, but they demand a high credit score, usually 680 or above, and their process takes several weeks. Private lenders charge a slightly higher rate, but they can work with credit scores down in the 500s and can literally get you funded in just a few days. BDC kind of splits the difference, offering moderate rates with a 10 to 30-day timeline. The big takeaway here is that finding the best option isn't just about blindly hunting for the lowest rate. It's about perfectly matching your specific timeline, your credit profile, and your business reality to the right lender. Actually, scratch, just looking at the rate, we really need to talk about the true cost of those so-called cheap bank rates. Think about it. If a bank takes 5 weeks to process your paperwork, what is the cost of that downtime? A higher interest rate from a private lender might actually be vastly cheaper overall once you factor in bank-side application fees, appraisal fees, and most importantly, the massive opportunity cost. If waiting weeks for an approval means you lose out on a lucrative contract, well, those initial rate savings instantly vanish, right? Which brings us to section 4, industry application, financing in the field. So let's look at how this applies in the real world. Modern agriculture, for example, requires immense capital. Major institutions like RBC offer flexible agricultural equipment leases designed specifically to help farmers preserve their working capital. Because instead of dropping a massive lump sum all at once on a harvester, leasing lets an operation keep cash on hand for critical daily input costs. Plus, depending on the structure of the farm, these lease payments can sometimes be 100% tax deductible. And here's another brilliant strategy used in this sector: establishing a lease line of credit. Basically, an operator can get pre-approved for a set amount before the buying season even begins. This means they can manage multiple equipment upgrades like new tractors or advanced harvesting tech all under one umbrella. And they can choose fixed or variable interest rates depending on how they want to manage their cash flow over the long term. And this brilliantly illustrates our next part. Section 5. Real-world scenarios. Which buyer are you? Let's look at Dave. He's an established contractor, 12 years in business, rocking a fantastic 730 credit score, and bringing in a highly profitable net income. He wants to buy a brand new cat excavator. Listen, Dave is a textbook bank deal, through and through. He's got the pristine history, the strong financials, and the time to wait. He should absolutely leverage his solid standing to secure the lowest possible interest rate from a traditional bank. Then we have Sarah. Her excavation business is only 18 months old, but she is crushing it, generating $35,000 a month in revenue. She found a killer deal on a used 2019 Komatsu. But if she goes to a bank, they'll decline her instantly, simply because she doesn't have 2 full years of tax returns yet. A private lender, though, they will eagerly approve her. They'll look at her strong, recent bank statements and the solid resale value of that used Komatsu and get her funded quickly. What about Mike? He's been in business for 8 years with solid revenues, but a really messy personal divorce recently tanked his credit score to 590. Now he needs a $140,000 Bobcat. At a traditional bank, a 590 score literally ends the conversation before you even sit down. However, a private lender will look past those personal credit bruises. They're going to focus on his 8 years of successful business history and the strong market value of the Bobcat itself. Finally, let's look at Lisa. She just won a massive $400,000 municipal contract that starts in exactly 3 weeks. And she needs a Cat D6 dozer on site immediately. Even if Lisa has absolutely perfect credit, a bank simply cannot underwrite and fund a loan that fast. It's just not how they're built. So Lisa gladly takes a slightly higher interest rate from a private lender to get her machinery delivered in a matter of days. Because honestly, waiting for a bank would mean losing a massive contract and all the profit that comes with it. No way she's letting that happen.
Let's move to and see how this builds into our final section, Section 6. Choosing your best option, next steps.
So, what's the play here? The smartest operators in the country, they don't just pick one lane and stay there. They use a hybrid fleet approach. They use the slow, cheap bank loans for their core long-term fleet to maximize their savings. But when a surprise contract lands or an amazing deal on used equipment pops up out of nowhere, they pivot to private lenders for that speed and agility. And remember, you can always use a private lender to get the machine working and generating revenue today, and then just refinance it through a bank a year later to lower your rate. So before you apply anywhere, just run through these 5 quick questions. 1. Is your credit over 680? Try the bank. Below 650? Go private. 2. Do you need the machine in under 3 weeks? That's a private lender for sure. Got a month or more? Look at BDC or a bank. 3. Is the equipment new or used? Banks love new. Private lenders love used. 4. Have you been in business over 2 years? And 5. Are your audited financials ready to go? Or do you just have recent bank statements? Let your answers to this checklist guide you directly to the right institution. When you step back and look at the whole picture, the biggest mistake you can possibly make is trying to force your business into the wrong lending model. Time is money, and opportunity cost is a very real thing. So ask yourself, is your next equipment purchase going to sit in an underwriter's queue burning weeks at a bank? Or is it going to be funded fast, getting out into the field and building your revenue today? Thanks so much for joining me for this explainer, and here's to building your business smarter.